Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts.
All right, good afternoon, everyone. Welcome to this afternoon's webinar. Today's session will be hosted by Dan Sugar, who will be teaching us all about ETFs, and this is part one of a two-part series. Dan is a third-generation Chicago trader who entered the trading world as a runner on the floor at the CBOE in 1980. He spent 8 years there trading Treasury futures and Dow Jones stock index futures on the Chicago floor of the Chicago Board of Trade. In 1996, Dan left the floor and began trading stocks, futures, options, and FX from the screen. Dan helps his students gain financial independence using his own knowledge and real-world experience, as well as helping them learn the rules and tools to succeed in their own trading. So Dan is with us now. I'm going to go ahead and turn it over to him, and we're going to get started this afternoon.
Great. Thank you very much, Katrina. I hope everyone can hear me. It's about 4:30 East Coast time. Thank you so much for attending. We got a lot of great information on exchange-traded funds, some of the benefits for mutual funds and tax advantages and lower fees and so forth. So let's get right into it. We've had a lot of volatility the last couple of days, so we can unstrap our roller coaster seatbelts on because we've had a lot of volatility the last couple of days. So we'll show you how to use these ETFs to capitalize and take advantage of this volatility and so forth. So let's get right into it. Again, my name is Dan Sugar with Online Trading Academy. The actual website is tradingacademy.com, so you can remove that online, but the actual website for our firm is tradingacademy.com, even though we're called Online Trading Academy. And let's go to the second slide there. So okay, so a couple, let me take 90 seconds or a minute and a half or so to listen about our company. We were founded in 1997 in Irvine, California. We're on the West Coast. Right now we do have 37 branches around the world. We're in about 5 different countries, in case you've never heard of us. Some of you have probably seen some of Steve Mizik's great presentations on this platform before as well, so you're probably familiar with it. But in case this is your first time, we do have branch offices in Singapore, Dubai, Abu Dhabi, Indonesia, India, Ireland, London, and Canada. We just signed an agreement to be in Hong Kong, so we're going to be there as well very shortly. And then we do have 30 centers or so, 30 or 32 centers around the United States in large metropolitan areas: Dallas, Secaucus, New Jersey, New York, Chicago, 3 separate in Florida where I'm at right now, Orlando, Tampa, and South Florida, Denver, Charlotte, Atlanta, and so forth. So we do teach all asset classes: stocks, equities, options, futures, currencies, and then we have a nice 5-day proactive investing for your 401k or Roth IRA or retirement account, like we call the big bucket retirement funds. We do offer a free 4-hour power trading workshop. So you can definitely go to tradingacademy.com and click on your city, find out your locations if you're in Canada. We are up in Vancouver and Toronto as well. But take advantage of, we have a great free 4-hour workshop from 10 o'clock to 2 o'clock. On our webinar this afternoon also, we're happy to announce that we're joined by Nolan Lewis, who is one of our employees at the corporate branch in Irvine, California. He helps students with our XLT platform, which is our continuing education platform, as well as any other questions regarding our curriculum or classes or so forth. So you can email him at nolanl@otahq.com. His name is Nolan Lewis, and again, the email address is nolanl@otahq.com. And he's got a direct phone number as well, 949-608-6006. So thanks, Nolan, for coming on with us this afternoon. I've been with the company since December of '97. I really enjoy getting away from the screen. I'm a full-time trader. It's great to get away from the screen 7 or 10 or maybe 12 days out of the month to go ahead and share my knowledge with hardworking students that come to our branches. So it's a big kick for me to share my knowledge. I do get professional satisfaction from doing that. And again, it's great to get away from the screen a couple days a month to travel and spend some 7 days with students. All right, so getting back to today's lesson, gang, we're going to go over the introduction, what are ETFs, the actual definition, some of the leading ETF sponsors, different types of ETFs we're going to cover. Actually, this is a two-part series, so the second hour will be, I believe, September 7th. We're going to cover dividend ETFs, emerging market ETFs, international ETFs. You know, we have ETFs now on Brazil, Russia, India, and China, the BRIC countries you guys are all familiar with. So we're going to cover that as well as part two. We're going to talk about leveraged ETFs, inverse ETFs, which is a hot topic right now because, you know, the market's down about 10% or so from the last week or two highs. So how to use inverse ETFs. For those of you that have a cash account or an IRA account and you're not allowed to sell short in a bear market or a 5 or 10% correction, you can learn how to use inverse ETFs that will go up when the market goes down. And at the end, we'll definitely have some time for some Q&A. I'm seeing someone saying the audio was terrible. Hopefully you guys can hear me clearly. Hopefully it's just a short delay or something. But can everyone else hear me clearly? Shoot me a yes if you can hear me clearly, please. Okay, so unless you're living in a cave lately, you've heard about explosive growth. If you're an active investor and trader, the ETF boom has been very, very powerful. It's reshaping the investment landscape by challenging traditional mutual funds and giving investors and traders, large and small, the opportunity to get exposure to virtually every major market and asset class in the world, and even some minor ones. Last year, we had over $100 billion in net inflows in 2010. I mean, now we're in August, so it's almost, you know, we're almost in 2012, but last year we did have $100 billion in net inflows. So very, very powerful growth. And it's one of Wall Street's best innovations for the individual active investor or trader in the last, 15, 20 years. The original ETF started in 1993. Does anybody know out there, who knows what the original ETF is? I'll give you 5 seconds. I'll buy a lunch if you know. It's Spiders, SPY, is the original ETF. It goes back to late 1993, so it's 17, 18 years old. So back then, they weren't really prevalent for large or small active investors. They were for big institutions. If you were a money manager at Fidelity or Vanguard or Charles Schwab or Van Camp and Merritt or Templeton Funds, you could buy or sell the whole S&P 500 with one transaction by buying a spider, buying 100 shares of spiders or selling 100 shares of spiders. The ticker is SPY, so that's why they're called spiders. And the mutual funds still dominate the industry. There's about $8 trillion in mutual fund assets, and ETFs have over $1 trillion now. We surpassed the $1 trillion mark in October of last year, 2010. So here we are, August. We're probably at 1.1 or 1.2 trillion dollars. Yeah, I'm not using headsets, so I'm just on my speaker. Let me try. Does this sound any better? I just did it on speaker, so I'm not on a headset. But is this better for people? I'm talking right into the phone now, so hopefully this is clear. Okay, great. Awesome. Thank you. Awesome. Okay, so mutual funds still dominate. There's about $8 trillion in assets, and ETFs have about 1.1 or 1.2 trillion. This data is up to date as of like June, actually. So we're probably at 1.1 or 1.2 trillion in ETF assets. So we still have a lot of room to grow. Mutual funds still dominate, but the more people get educated and find out the tax ramifications, the tax benefits, and the lower expenses, which I'm going to go over in 20 minutes or so, I'm sure the ETFs are going to catch up to mutual funds probably in the next 18 months or 2 years. The majority of the ETFs do trade on the American Stock Exchange, which is owned by the New York Stock Exchange now. The rest trade on the NASDAQ, NYSE, and the ISE, International Securities Exchange. 2005, 6 years ago, there was $314 billion in assets and about 221 different ETF choices out there. And now we have over $1 trillion, like we talked about. And there's over, probably now there's 1,100, because again, this is current as of June. So now that it's August, it's about 1,100 ETFs out there. So phenomenal growth. What is an ETF? It's just a security that tracks an index, a sector, or an asset class, like bonds, currencies, commodities, real estate, but it trades like a stock on an exchange, okay? So there's a open, high, low, and close. If you buy a mutual fund, we've had a nice sell up the last couple of days, and if you think, now's a good dip to buy and go long some mutual funds off this recent sell-off, and tomorrow you're going to buy a mutual fund online at 11 o'clock in the morning, or you call your broker at 1 o'clock or 1:30 in the afternoon and talk with them, you're going to get filled or executed at 4 o'clock Eastern Standard Time, which is the net asset value. Mutual funds do not trade throughout the day. Okay, there's one trade. It's at 4 o'clock, and it's called the NAV, the net asset value. ETFs experience price changes throughout the day as they're bought and sold, so you do have an open, high, low, close. In the last couple of days of volatility game with these big sell-offs, if you're watching the market and the Dow Jones is down 200 or 250 or 300 points or so, and you want to bail out of a mutual fund, but it's only 12:30 in the afternoon, you can't do it. You can put the order in online or talk to your financial advisor or a broker or directly with Fidelity or Vanguard or whoever, but you're not going to get executed until 4 o'clock. And the Dow could be down 400 or 500 points by then. So, to manage risk and to be able to bail out of investments or trades quicker and more efficiently, it's a lot easier with ETFs. Trading ETFs averages about $62 billion a day, and ETFs do account for 25% of the volume on the exchanges. Okay, so there's a lot of volume on the exchanges on ETFs. 1/4 of the volume on the exchanges is ETF volume. So if you were along the TLT, getting back to the bonds or the currencies or commodities or real estate, the bond, the big bond 20-year ETF is the TLT. The symbol is the TLT. That's been going up like gangbusters because the yield on the 20-year, the yield on the 10-year note has dropped from 2.9 to 3.0 down to 2.55. So as yields go down and money flows into the bonds, government securities, or the TLT, which is the ETF that tracks bonds, the TLT goes up as yields come down. And the TLT has been, on fire, going up the last 3 to 4 weeks, and actually the last 4 or 5 months. Money's been flowing into bonds, and TLT has been going up, and yields have been coming down sharply and aggressively. ETFs were really the best of both worlds. In 1983, the mutual fund moved into the 21st century when the American Stock Exchange introduced the very first U.S.-based exchange-traded fund, which again is a SPDR's, SPY. So some of the common traits like a stock are, they do have trading flexibility intraday on the exchange. They open up at 9:30, they close at 4 o'clock, so there's an open, high, low, and close. You can use limit orders, you can use stop losses, and you can use market orders on these ETFs. So again, a much better way to be able to manage risk. If the Russell or the Nasdaq or the S&P or Dow is down 2.5% or 3 or 4% in a day, you don't have to wait till 4 o'clock to get to your mutual fund. If you want to, do some sector rotation or just take a loss or take a profit, ETFs give you so much more flexibility. You can monitor them continually throughout the day, and you can chart them. We teach technical analysis in our live classes, and if you're familiar with, 5-minute charts or 30-minute charts or daily or weekly charts, or candlestick charts or line charts or bar charts, you can monitor these ETFs and look for supply-demand zones, trend lines, and patterns like head and shoulders. Mutual funds really don't like to do that. They do have some characteristics like an index mutual fund because they are constructed to track benchmark indexes like the Russell, Dow, S&P, Nasdaq. You guys are familiar with the Philadelphia Semiconductor Index, the SOX. Well, there's an ETF that tracks the SOX index, the SOX, which is semiconductors. That's the SMH. And with a single purchase, it provides instant diversification. If you go along and purchase the TLT, you know you have exposure to the 20-year bond. As you buy the SMH, you know you have exposure to 15 or 20 of the top semiconductor ETFs. Semiconductor stocks that make up the SMH, which is the semiconductor ETF. So single purchase or sale provides instant diversification. I'm going to talk about the XLF shortly too, and the XLF is the financial ETF of the sector SPDRs. The Standard & Poor's company and State Street Global Advisors, they chopped up the stock market into 9 different sectors. XLF is financials, XLK is technology, XLE is energy, XLU is utilities, XLV is healthcare. So we're going to cover some of those acronyms and those symbols and the sector rotation shortly. But if you keep an eye on the XLF, they have financial ETF, which is comprised of banks, broker-dealers, and insurance companies. That peaked in February. that peaked out at a price of about $17.20 per share and dropped about 20% to, today's low was like $14.10 or $14.20, about $3. And the broader market didn't, did not peak until May 2nd when we got Bin Laden, called the Bin Laden high. So if you look at financials, which is what I call an alpha sector or an alpha index, the financials, so it's very difficult for stocks to be in a bull market without the participation of the financials. Again, banks, broker-dealers, and insurance companies. So if you're watching sector rotation and keeping an eye on the XLF, even if you never trade the XLF or invest in it, you really need to keep an eye on it because it's an alpha sector. And again, the XLF peaked in February, and then the broader market peaked about 6 or 8 weeks later, May 2nd. So one little good example of keeping an eye on the XLF. So again, a single purchase, if you buy the XLF, you're getting exposure to Goldman Sachs, Wells Fargo, Citibank, Bank of America, Prudential Insurance, all kinds of, insurance banks and broker-dealers. So instead of trying to pick the next, Apple or Google, you just want exposure to the financial sector, you can buy or sell the XLF with one purchase. Sure, Mark. And the XLK is the technology. XLE is the energy ETF. I'm going to have all these acronyms on the slides coming up shortly, so you'll be able to get a screenshot and write those down. One of the really nice benefits of exchange-traded funds, gang, is the low expenses and low turnover. So we're going to show you exactly how low those expenses can get. So with an ETF, we're just a hybrid of stock and a mutual fund together, the best of both worlds. It's got the best characteristics of an individual stock and much lower expenses and fees than a mutual fund. Mutual fund of a net asset value, again, you can only buy or sell those at one price, one time per day at 4 o'clock. Okay? Mutual funds do not trade out today. Net asset value at 4 o'clock only. ETFs are lower cost or expense ratios than mutual funds. I mean, if a mutual fund is getting 15 or 20%, and it costs you 2% to get in, and then there's some 12B1 fees to cover their marketing expenses, then it costs you 1% or 1.5% to get out on redemption fees, you might have 3 or 4% in fees, and so if it's getting 50% before the fees, when you've done paying the 12B1 fees and the redemption fees and the upfront sales charges, it might be 4 or 5%, so now your 15% of mutual fund is down to 10%. And again, how many mutual funds are doing 15% these days? Not that many. So ETFs can save you money, and the more money you save on expenses and taxes goes right to your bottom line for your retirement qualified accounts or for your regular non-qualified accounts. They will generate brokerage commissions when you trade them. Okay, so you're going to get your, E-Trade or Scott Trade or Fidelity brokerage or Charles Schwab or Trade Station when you do make a trade. So some of these firms have waived commissions. I know, for instance, you've seen the ads for Fidelity. If you open an account at Fidelity, they offer about 25 or 30 of the iShares ETFs where you can buy and sell them for free. So they'll waive those commissions, and we're going to talk about iShares. They're one of the biggest ETF sponsors out there. They dominate the market along with Vanguard. So we'll talk about that shortly. But if you're at Charles Schwab, some of the there's Charles Schwab will have some in-house ETFs on their own proprietary Schwab ETFs. So they waive commissions on some of their own in-house ETFs. But we'll warn you, some of these newer ETFs that Charles Schwab has rolled out, they're not liquid, meaning there's not a lot of institutional participation, not a lot of retail investor interest is set. So the spread between the offer is very large. It's not going to be 1 or 2 or 3 pennies like a lot of the active liquid ETFs I'm going to show you today. So just because you save $6 or $8 on a commission, you might be getting a bad execution cost with increased execution costs. Again, if it's not a liquid ETF, and the spread between the bid offer is 5 or 10 or 15 cents, it costs you 5 or 10 to get in and 5 or 10 to get out. So that nullifies the free commission. So do your due diligence, make sure they're liquid, they're building volume. And the best way to find out if it's a liquid ETF or not is to pull up a chart and see what kind of volume they're doing. Are they doing, 1 million or 1.5 to 2 million shares per day? Okay, and also check out the spread between the bid offer. Like again, if you're trading through Schwab or E-Trade or StatTrade or Interactive Brokers or any of these, active platforms, TradeStation as well, who we use, and we love TradeStation for their low commissions and great technical analysis platform. But pull up the chart and see what the spread between the bid offer is. If it's, like if you choose, it's 1 penny, or the XLK or XL, if it's 1 penny between the bid offer. If it's a Scotch trade, besides Schwab, Scotch trade, Roger Riney, he's also introduced some in-house proprietary Scotch trade ETFs. Some of them are good, great. Many of them are not liquid yet because they're relatively new, 3 or 5 months old, and there's not a lot of liquidity yet. So, yeah, very good point there. And, don't save $7 or $8 on commission to spike your face type of thing and reduce liquidity on the ETFs. So some firms have waived them, but if they haven't, then you can make your $6 or $7 charge. Or in TradeStation's case, you can do 100 shares of an ETF for $1. TradeStation, Interactive Brokers, and some of the direct access broker platforms have really reduced commissions.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.